So in this video, I'm going to tell you the truth about why you should not pay down your mortgage early, even though I know it sounds like the right thing to do, and it's what we've always been told. But first, hit that subscribe button to make sure that you're always updated with the latest strategies and tips that are perfect for home buyers. So look, I've been a mortgage lender for over 17 years. My team and I have helped over 4,000 families or individuals buy, invest, or refinance homes. And one of the most common questions we get both after closing and during people's home ownership journey is about making extra payments and how they should go about paying down their mortgage faster, because it's something we've always been told is a good thing to do. And oftentimes people do have money left over in their budget at the end of the month, so they're really thinking about, how do I do this strategically? And they kind of understand the pros, right? Pay your mortgage down faster, which means pay your home off faster, but people don't really think about the cons, or the opportunity cost, as I like to say. Now, for the first half of my career, I was an advocate of paying your home off faster. The math made sense. I just kind of thought about it from a math standpoint. Pay your home off faster, pay your home off early, own the house free and clear. However, over the last 7-8 years, my investment philosophies have changed a bit, and I no longer think it's a good idea to pay your house off faster, especially if you're a first-time home buyer. I got some really interesting data, and I'm going to tell you why. Okay, so I've broken this down into a couple topics to really help us think this through. The first one is that people have a false reality of their timeline in the home. So remember, there are two common ways to pay your mortgage off faster. You can literally just round up your mortgage payment and pay a little bit extra every single month. And there's a really common way, which is called bi-weekly payments. So instead of making one mortgage payment at the end of the month, you basically divide that mortgage payment into two, and you pay every 2 weeks. Mathematically, over the course of 1 year, that ends up equating to one extra payment per year. Most people are very familiar with the bi-weekly payment strategy. And again, over a 30-year period, that extra payment per year cuts down 6 to 7 years off your mortgage. And that sounds pretty good, doesn't it? Shortening that 30-year mortgage down to 24, 23 years. Makes sense, right? Well, here's the deal. Most home buyers are not in their home for 30 years. In fact, most first-time home buyers move somewhere between year 3 and year 5. So just think about that for a second. All the math around paying your house off early is predicated on you being in that home for 30 years. So people have a false reality of how much time they're actually going to spend in that home. And I don't know about you, but I don't know anyone who's been in their home for 30 years, not even my grandma. So the next topic to consider is your return on investment, also known as your ROI. So again, we think making extra payments each month is going to shorten our 30-year loan. But remember, you're not going to be in your home for 30 years. So what I want you to think about is your return on investment. Let me break that down for you. If you have an extra $250 a month and you take it out of your bank and you make a payment to your mortgage lender, your bank, right? So you take it out of your checking account, you go and you pay your mortgage balance down, $250 more. What's your return on the investment? Are you getting interest on it? Is your bank, your mortgage company who's collecting that mortgage payment, what are they giving you? Nothing. That's the answer, by the way. So that extra $250 you had that could be invested earning is now with your mortgage lender, and you have zero ROI. Now let's look at this over a 5-year period. Let's say you're a first-time home buyer and you're going to pay an extra $250 a month over the next 5 years. 250 times 12 is $3,000. So that's $3,000 a year times 5. That's $15,000 of your money that you've given the mortgage lender, which, by the way, gives you no return on investment, and you get zero back. And it doesn't lower your mortgage payment either, by the way. This is not a credit card. Mortgage payments have the same payment from payment 1 all the way through payment 360, which is what a 30-year mortgage looks like. It's 360 payments. So not only is there no return on investment, but your mortgage payment doesn't drop. So instead, what if you took that extra $250 a month and you invested it with a really good financial advisor that got you about a 10% return every year on your money? Over that same 5-year period, that $15,000 would now be worth about $20,000. And guess what? That money is accessible and it's liquid to you at any time, which takes us to the next point, liquidity. Liquidity is the ability to access your money. Is it liquid? Is it accessible? Can you touch it and get it when you need it with little to no fee or penalty? When your money is tied up in your home, it's your equity. Equity is not really liquid. It's not accessible quickly. To get your equity, there's two strategies. You can take out a home equity line of credit, which usually has a little bit of a fee to it and it takes a couple weeks, or you can do what's called a cash out refinance, which is a whole process. There's some cost to it and it takes anywhere from 3 to 4 weeks. That is not very liquid at all. Now, on the other hand, if the money's invested with a financial advisor, or it's in your brokerage account, or it's in a high yield savings account, you can access that money within 24 hours with little to no fee or penalty. So think about those topics for a second. Your timeline in the property, your return on investment, and the liquidity or accessibility of that money when you need it. Another topic that people very rarely consider when they're thinking about paying off their mortgage early is the safety of that cash. Paying down your mortgage early can actually be a safe place to park your money in some circumstances, because it's kind of like a forced savings account. When you make that extra payment, that money goes to your balance, it's in your equity, and you can't really touch it. For some people, they like that actually. But here's the issue. What if home prices drop 10 or even 20% like they are in some cities across the country? Now, it's 2024 right now. Home values have gone up for the last 7 and 10 years. They've peaked. They're the highest they've ever been. What does that mean? What goes up could come down. There could be a correction. Home values are already dropping 10% in cities like Austin, Texas. So if your home was worth $500,000 and it drops 10%, it's now worth $450,000. Guess what? You just lost 10% of your equity. And there's nothing you can do. It's like watching the stock market. It moves on its own. It's impacted by different variables. So is the housing market. You can literally wake up one day or 1 month and see that home values have dropped 10 or 20%, and that means a part of your money, your equity, is gone. Now, you're probably thinking, well, what if the stock market drops, or what if my investment drops? Guess what? You can take that money out and move it into your checking account and keep it as cash. So in other words, if the stock market starts to drop 5 or 10%, or if the brokerage or the investment account starts to drop based on whatever your investments are, you can sell those investments, move the money back into your checking or savings account, and it sits there as cash. It's protected. That's what safety means. Or you're already working with a financial advisor and they're one step ahead of you. That's what they do for a living. They literally manage investments to preserve people's money and to make sure that it's diversified to avoid risk and to increase appreciation and return on investment. And the last thing to think about here is the long-term impact of compound interest as it relates to saving for your retirement. I think most first-time home buyers and young adults grossly underestimate the power of compound interest over their lifetime. Let's take that $250 a month example. Over a 30-year period with a 10% return, that $250 a month could be worth over $500,000 when it's time for you to retire. Investing more money into your 401k or even an IRA is going to give you a much greater return over the next 20 to 30 years, especially because that money can grow tax-free and is liquid when you retire. Now, if you haven't bought a home yet and you're not sure where to start, I'm also sharing my free homebuyer checklist with you. The link can be found below the video. Now, I hope you found this information valuable, and if you did get some insights, please like this video and subscribe to the channel.